In the last video, we looked at my bullish step-by-step trading process and for which bullish patterns I look for in price action. And today I'll provide my bearish patterns and show you my personal bearish step-by-step trading process. As I have mentioned in the previous video, we always start from the condition. I have bullish and I have bearish conditions that I'm looking for to be present in the marketplace before I look for my setups. Only after either bullish or bearish conditions are fulfilled, I proceed to the pattern recognition stage of my trading process. At this stage, I start hunting for my patterns to execute on in price action. If bullish conditions are fulfilled, I hunt for my bullish patterns to execute on in price action. And if bearish conditions are fulfilled, I hunt for my bearish patterns to execute on in price action. After either bullish or bearish conditions are fulfilled, and one of the patterns that I'm looking for presents itself in price action, I proceed to the execution stage of my trading process. At the execution stage, I define my entry point and my stop loss level. This allows me to define the risk as well as my potential reward. If I'm satisfied with the potential reward, I execute on the trade idea. If I think the reward isn't worth the risk, I wait for another setup as long as the conditions continue to hold true. If I decide that the risk is worth it, I enter the trade. At that point, the trade either works or it doesn't. In any case, I go on to the next trade and repeat the described trading process. I know that individual trade outcomes are independent and random, but over a series of trades, they produce consistent results. That is why I always trade in sample sizes of 20 trades or more. That way, I make sure that I'm thinking in probabilities and judge the viability of my edge based on the results of at least the next 20 valid trades or more. In other words, I determine my success on the results of my valid sample size rather than on a trade-by-trade basis. In this video, we'll focus only on my bearish trading process. Because our goal is to take only the lowest risk trades with the highest probability of success, we always start our trading process with the condition stage. At this stage, I'm trying to determine the higher time frame directional bias. My objective is to determine where price is likely to trade to next and/or where is the market likely drawing to. The market is always drawing to either an old high and/or an inefficiency above the current market price, or an old low and/or an inefficiency below the current market price. I use a precise step-by-step process to determine if the price is in fact likely to trade to an old low and/or an inefficiency below the current market price. And until that process or my bearish conditions are fulfilled, I do not, under any circumstances, engage the marketplace, because I know that the risk just isn't worth it. Rather than risking my money on a 50-50 gamble, I am patient, and I demand that my bearish conditions are present in the marketplace. Because once bearish conditions are fulfilled, that gives me my higher time frame directional bias, which puts the odds of success in my favor. Here's my step-by-step process of determining higher time frame directional bias, or in other words, where is the market likely to trade to next, or where is the market likely drawing to. I start with picking a market that I'm looking to trade. After that, I determine if the market's seasonal tendency is currently bearish. If there is in fact a bearish seasonal tendency currently present, I proceed to the top-down analysis. I start my top-down analysis on the monthly chart, and then I repeat the process on the weekly, daily, and the 4-hour chart. These are my higher time frame charts. For the top-down analysis, I start with noting the present trading range, and by looking at where have we recently traded from. After that, I'm trying to determine institutional order flow. If up-close candles are resisting price and/or large candles form with down closes and/or price has recently reacted bearishly on a premium array, for example, price has a sharp rejection after trading above an old high, institutional order flow is bearish. When higher time frame order flow is bearish, I carry higher time frame PD arrays to intraday charts, 1 hour, 15 and 5 minute charts. If the above conditions are not true or not clear, higher time frame is neutral. Wait for bullish conditions to be true or wait for the above conditions to form. Don't do anything for now. Once bearish institutional order flow is determined, look at the commitment of traders report. If commercial hedgers are in a short position, look for intermarket relationships to confirm the long trade. Look for positively correlated assets to support your short trade idea, and look for negatively correlated assets to mirror the short trade idea. If this is not true, do not do anything for now. If intermarket analysis support the short trade idea, proceed to the pattern recognition stage. At this stage, I start hunting for bearish patterns to execute on the trade idea. I have three precise ways of identifying support and resistance patterns, and until at least one of the bearish patterns materializes in price action, I do not do anything. My first bearish pattern is the internal range liquidity. ICT calls it fair value play or the actual optimal trade entry. Price reacts from higher time frame premium array, and after that an impulse swing creates a fair value gap near the swing high. A short-term high forms in the market structure and fails to drop lower after relative equal lows or a lower low is formed. Price retraces up into the fair value gap and above the short-term high that formed after the initial impulse swing formed. Buy stops are triggered. Smart money uses offset distribution to pair short entries with the buy stop rate, premium entry. My second pattern is the external range liquidity. ICT calls it turtle soup. Price bounces prior to a higher time frame premium array, and then rallies higher into the anticipated higher time frame premium array, and rates buy stop liquidity pool. Buy stops are triggered. Smart money uses offset distribution to pair short entries with the buy stop rate, premium entry, turtle soup entry. And in case I miss my turtle soup short entry, or I want to pyramid my position, I can wait for my bearish pattern number 3, which ICT calls the bearish breaker block, and enter there. In other words, the bearish breaker provides a stage for my entry. After I identify one of my bearish patterns in price action, I proceed to the execution stage. Here's the step-by-step process that I follow for my executions. At this stage, I determine my entry point, I define my risk, and where I'll take profits. I start with determining my trade entry. Because all three of the patterns are universal, I can enter on any time frame that I see the pattern on, as long as it is in the direction of my higher time frame directional bias. And if I see the pattern on the higher time frame chart, I can start reducing it down into the lower time frame charts and look for the fractal of the patterns on the smaller time frames. I mainly look to trade on the 4-hour and 1-hour charts. And if I want to refine my entry points and minimize my risk, I look for the patterns on the 30, 15 and 5-minute charts. And if I want to be really precise, I can execute my trade on the 1-minute chart. Because my patterns have many different confluences, I have multiple trade entry options. I mainly enter on a limit order that I place at the low of the fair value gap, but I can also enter at the bearish order block, or I can simply place a limit order at one of the optimal trade entry levels. Most of the time, I like to go for the refined entry. That means that when I spot one of the patterns on the 4-hour and or 1-hour chart and price trades to one of my trade entry options, I then drop to the 15-minute and or 5-minute chart and look for price to displace lower and take out a short-term low. I enter with a limit order at the fair value gap that was created with displacement below the short-term low. If I don't get an entry on the fair value gap, I wait for one of my bearish patterns to form and enter with one of the previously discussed trade entry options. Once I know where my entry will be, I define my stop loss. I usually put my stop loss above the impulse swing high or above the lower time frame key high. I personally never risk more than 3% per trade idea. After we have defined our risk, we look at where we'll potentially take our profits. I follow key principles when taking my profits. That means that I pay myself as the market makes money available to me. I split my position into thirds or quarters and scale out as the market moves in my favor. That way I can lock in profits and experience a carefree and relaxed state of mind. For my final exit, I look for significant lows and/or inefficiencies below my entry point. I make sure to pay myself as price trades below previous day's lows, as well as when price trades below all weekly and all monthly lows. I also look to scale out of my positions at inefficiencies below my trade entry point. The inefficiencies can be fair value gaps, volume imbalances, and/or new week and new day opening gaps. Another way to determine my exit points is by using symmetrical price swing projections from intermediate term low to the intermediate term high. I place limit orders just above these levels to guarantee the fill. If I decide the risk is worth it and I enter the trade, I then proceed to the last stage. At this point, the trade either works or it doesn't. In any case, I go on to the next trade, because I know that individual trade outcomes are independent and random, but over a series of trades, they produce consistent results. I always commit to trading at least the next 20 occurrences of my edge, not just the next trade or the next couple of trades, but all 20, no matter what. This way I make sure that I'm thinking in probabilities, and only this way I'm able to measure my actual performance, which allows me to build up my confidence, which is paramount to sticking to my trading strategy. I have a rule that I cannot deviate, use, or be influenced by any other outside factors, or change the variables that define my edge until I have completed a full sample size. Until that point, I trade my system exactly as I have designed it. In the next video, we will study copper futures and how to use the presented trading process in practice. Please don't forget to like, comment, and subscribe so you don't miss our next upload.